Okay, so this is where I start to get dialed in. We've got some momentum here. This is actually up over 200%. And look at this squeeze. Up to 6, up to 650, up to 7. All right, I want to buy the first pullback. This thing is strong. And what do we see right now? A little resistance at $7 right there, the top of that candle. Let's get zoomed in on it. So we have the top of that candle at 7. It wasn't able to break 7. Okay, we'll let it pull back. It comes back up a second time. It taps 7 again, but it can't break it. What's it going to do next? It comes back up third try, still can't break it. Okay, we now have what is undeniable resistance at $7. All right, resistance is 7. Now, if it breaks 7, if we get the break of 7, what do you think is going to happen? What typically happens when we break resistance is we squeeze up to the next level of psychological resistance. In this case, that would be 7 to 750, then 750 up to 8. So I like this setup, and I'm starting to get dialed in. We watch it pull back one more time. It comes back up fourth tap of 7. So we've now got 1, 2, 3, 4 taps of 7. We haven't broken. All right, so now I'm watching traders and they're saying, I'm excited. I want to buy this thing. When this thing breaks, this wall at 7, it's going to explode. You know, sometimes when you have this kind of resistance, it feels like a dam. It's holding back the water. And when it finally breaks loose, that's when we get the big move. And often this is created when there's one really big seller that's just sitting right at 7. It's a whale and they're not moving. They're not going to move until all their shares are accumulated. So we get the pullback and then it comes back up and people buy more shares and it pulls back. But people buy more shares, it pulls back. They buy more shares, it pulls back. And then finally what happens? It snaps, it breaks loose. And watch this. Okay, we've got now 1, 2, 3, 4, 5 tests of 7. Whoa. We've got to zoom out this candle. This broke. It went up to a high of $7.60, and then it dumped all the way down to $6. Holy smokes. That was 1.5 million shares of volume in one candle. Look at this. That is a scary looking chart. I don't like seeing that, not one bit. And you know what? I saw some traders complaining that they just got smoked. They're like, I can't believe it. How does this keep happening to me? Another false breakout. I'm so sick of this. I know it's frustrating, but I'm going to tell you that with all of my years of educated intuition, this, well, it starts to become predictable. I'm not surprised that happened right there. Now, you might not notice it yet, but let me have you look at this chart. Is there anything you see here that indicates that this might not have resolved in your favor? Is there anything you can see here that indicates maybe this was more likely to do this kind of pop and then rejection? I can give you a list of a few things. And in this episode, what I'm going to do is I'm going to share with you the techniques that I use to help me avoid false breakouts. Because these types of false breakouts, also known as bull traps, they can steal a lot of money from your pocket, and it's not worth it. It can be incredibly frustrating, especially on a day like this where, let's just say perhaps, and we'll scroll back here, we'll make the chart a little bit bigger. Let's just say perhaps you were someone like me who got in way down here at $3. My first trade on this was at $3. I traded this all the way up from 3 to 350 to 4, 450, pull back, then up to 5. This was where I made the most money. This was the cleanest move. And I knew that that was going to be the cleanest move. How did I know it? Well, there's something that I look at on these types of charts. Over my years, I've noticed that typically it is the beginning of the move that is the cleanest. And that's what we have right here, the beginning of the move. Once we get the first pullback, one of two things needs to happen. The first pullback actually was right here. And when you get this pullback and it goes higher, we're fine. We're in good shape. I'm going to keep trading it. But once you get a pullback here where it is not able to hold at the 9 exponential moving average, and it instead breaks that price, that usually means the easy part of the trade is over with. Something you can also use as an indicator is the MACD. This down here is the moving average convergence divergence indicator. And when it crosses over right here, this is a very important thing to pay attention to. I would say that this marks the end of the front side of this leg up. Now, this could roll over completely and go all the way back down, or it could go sideways for a little bit and rally up one more time, but it's not surprising that it became choppy. We have the MACD crossover. We go into this period of sort of consolidation and then selling off. We break below our volume weighted average price. So now we're moving below these indicators. We're below the 9 moving average. We're below the 20 moving average. We're below the volume weighted moving average. All right, the VWAP. So this is just, it's weak. And then at the open, you get a little surge of momentum. It squeezes up here, back up to its pre-market high of 5. It pulls back just for a moment, does a little false breakout right here. Now, this was an early indicator of what was to come. When you start to see candles like that, it's a warning sign. You can choose to ignore it, but it is a warning sign and it's plain as day. All right, so let's look at it right here. This was the warning. This was the first one. Look at this candle. Right here, we had consolidation. We tried to break. It came up to 550, the $0.50, and watch this rejection. It dumps all the way down to about 490. And it does it on 700,000 shares of volume. That's a lot of volume. That's a big false breakout. That's a big rejection. And I'm sure there's people who bailed out. Now, there's other people who would take an opposite approach, which is to buy the dip. And I do like buying dips on these. Whenever I see this type of candle, I'm typically going to buy the dip. When I see a flush like that, I usually buy the dip and I set my stop at the low of the pullback. Now, sometimes the way I do it is I let it go red. And then as soon as I start to see green coming in, I start to see some buying. I'll see it in the actual orders that are going through on the time and sales. At that moment, I press the buy button, I set my stop at the low, and I'm looking for a bounce back up. So this actually gave us a nice bounce back up. We get a squeeze here up to this high of 710. It drops down. And then in this area here, look at each time we came up, it sold off hard. We come up, it sells off hard. We come back up, it sells off hard. So the fact that it kept reversing off this level, it made it very predictable that when it finally broke, likely there'd be a lot of people that would press the sell button for profit taking. And that's exactly what happened. In fact, in just 10 seconds, we had over 1 million shares of volume. And it hit a low down here of about 595. And this was a dip opportunity. It bounced all the way back up to 670, but it didn't hold. Sometimes these dips can rally all the way back up to the high, but they don't always. And in this case, it came back down, made a new low, and then kind of went sideways before coming a little bit lower. This is an example of an instrument where it was really thickly traded through this area. And there was a very obvious big seller that was just right here at 7. Selling, selling, selling. And so what sometimes happens is when that order finally gets filled, the price breaks, but then another order gets executed. A second order goes through, and it may even be bigger than the first one, and that person is just pressing the sell button. And I think that's what happened here. Someone dumped a ton of shares on this candle. It was probably 1 or maybe 2 really, really big orders. They just dumped their shares. And this might be someone who'd been holding for months, maybe years. It probably wasn't a day trader. It was probably someone who's been in for a long time. And they said, this is a good chance for me to sell 500,000 shares, right? Lock up a couple $1 million of profit, because that's going to happen. When you have something that's up 200% and you look at the chart and it's been beaten up for a long time, you're going to have insiders who are going to take the opportunity to sell. They're going to unload. So to me, the early part of the move is sort of the safest, because this is usually before people are really aware of the fact that the position they're in is up this much. Pre-market, 6, 7, 8 a.m., most people aren't going to be aware, if they've been holding something for a long time, how much the market is moving. They won't even probably check until 9:30, maybe 10 a.m. Maybe they'll have an alert that's triggered. So it's very, very common that the early part of the move pre-market is super clean. And then as we get into the open, it's when things get choppy. So right here, we get this nice move higher on decent volume, but we had one sort of nasty rejection candle, and then we have another one right here. So what was happening with the MACD at this point? Well, the MACD was actually against the trade, right? We went sideways for too long. This is a problem. When you go sideways for this long, it's so obvious that there's not enough strength. The buyers, they're not strong enough. The very fact that it's going sideways is weakness. Now, some people would say, look, it's holding up, it's holding up. Yeah, but it's not breaking higher. And look at these red candles. And let's look at the volume profile. Which candles have the most volume? Red candle, red candle, red candle, red candle, red candle, red candle. So what's happening here? Is there more buying or is there more selling? The volume profile is telling us there's more selling. The MACD has crossed over against the trade. And we've already seen an example of a massive flush right here on a red candle. So to me, all the warning signs are there. Now, at the beginning of the move back here, there were no warning signs. We had tons of volume. It was all green. And so the way I'm trading this is I'm buying those first pullbacks. This is my strategy for the most part as a momentum trader, but specifically focusing on trading these areas of peak volatility, because this is when the chart is the cleanest. I mean, this is when we're seeing these big moves. This is where I'm making the most money. So this is what I call my micro pullback strategy. So as the stock starts to squeeze up, I let it pull back, and then I'm either buying these pullbacks here, or I'm buying this pullback here, or this pullback here, or I'm trading sort of all of them as it moves higher. Now, for those of you guys tuning in, if you haven't already downloaded my micro pullback strategy PDF, it'll be pinned to the top of the comments, and it'll be linked in the description. So you could download that, you could print it out, you could put it next to your desk, next to your workstation, and that's going to be a guide for you of how I trade these types of stocks. It's going to walk you through how I'm finding the stocks, basically my stock selection process of how I quantify that this is the right type of stock to focus on, and then exactly where I'm getting in and where I'm getting out. And all of that is to help protect me from the downside risk of getting caught in bull traps and in false breakouts. By trading these early, this is when it's the cleanest. So this stock, by the way, the float on it is 1.3 million shares. So this is a very low float stock. This is the type of stock that can make a big move. It's got the news catalyst. So, in terms of just breaking down what made this the right one to trade, we had the float. Number two, it was already up at least 50% by the time I was seeing it. It was moving fast. Number three, the price is between 5 and 10. This really, for me, is the sweet spot. Now, at the beginning, it was a little bit lower, and that actually did give me some reason to pause on this one. But even in spite of that, it still gave some really good opportunities. And as it got a little higher, it became a little easier to trade. And then, of course, I look for stocks that have high relative volume. And I look, of course, for the catalyst, the news headline. So when I see all of that, then I'm looking at the chart and I'm looking for that micro pullback. So really, it's just a momentary pause before the next leg up. So, again, if we look at this chart and we start to break it down in more detail, what are we going to see? The MACD was open and in favor of the trade as the price is moving higher. Yes, we got one pullback here, which was fine. It was a light volume red candle. That's an area to buy the dip. That's totally okay. I love it. We got to move higher to 560. That's great. And then this area we're pulling back, granted on lighter volume, but the MACD crosses over. So we get the MACD crossover. Whenever we have a MACD crossover, it increases the likelihood that it comes back up here. It's going to be a double top and it's going to reject. Very unlikely for the MACD to be against the trade and for it to squeeze up like this. So it squeezes up, reverses, not surprising, comes back, double bottoms at about 460. And I started thinking about this like, all right, maybe we could get a leg higher. So at this point here, what I'm saying and thinking to myself is we've got to hold 460. And I would watch this to break over this pivot right here. But I most likely wouldn't buy until the price comes up to that area. When the price gets up to that area, you know what's going to be happening to the MACD? It's going to be crossing back over in favor of the trade. And what's likely happening is this is a 1 minute chart. On the 5 minute, we probably have a bull flag, right? This is a 1 minute, this is a 5 minute candle. There's another 5 minute candle, another 5 minute candle. So you've got green 5 minute candles, a little red candle, maybe a candle that kind of made a new high like this, then a candle here. And so you're sort of looking at this as an ABCD pattern, right? So now let's cross-reference and actually check the 5 minute chart. So we look at this on the 5 minute time frame. All right. And now you see, okay, so we've got three big green candles, 4 big green candles, a pullback, and then this candle tries to push higher, but it's not able to do it. Now, one thing I would say about this is look at how extended this is right here on the 5 minute off the 9 moving average. Oftentimes when you get something that goes parabolic like this, That's the cleanest move. Maybe it'll go up to 7 to 8 in the first leg of that parabolic squeeze. But once it starts to pull back, it really needs to pull back a lot before buyers are going to feel comfortable getting back in. So it does end up pushing back through the high of 550, which sort of surprised me after that rejection candle on the 1 minute. But it did push a little higher, and then boom. And you could say, well, geez, this even looks like a decent 5-minute setup. Well, it's a little extended, still off of that 9 moving average. And unfortunately, the MACD on the 1 minute is against the trade. When the MACD is against the trade, when you have a history of these high volume red candles, and you have already an established history of red candle rejections like that, your odds of seeing this kind of flush are getting really, really high. I've just seen it so many times that at this point, it's predictable. So this is your checklist. These are 5 indicators that increase the likelihood of seeing a false breakout. 1, when the MACD is against a trade. 2, when the volume profile shows high volume selling. 3, when the stock already has a history of false breakouts. 4, when you have several topping tails in a row or topping tails at the resistance level. And 5, when it's been consolidating for too long. So let's look at a couple other examples, because this is just the latest example from today. We had one yesterday that was also pretty dramatic. So VSTE yesterday, let's pull this chart up. All right, so yesterday morning we had this move here. So pre-market, basically the news comes out and it just surges up. However, it does pull back, pretty dramatically on higher volume selling. So higher volume red candles, it comes back down. It does manage to rally back up a little bit later in the morning. So it comes back up here to a high of, let's see, let's watch this curl up to 11. It pulls back again. And then right there's 1150 here. Now let's look at this for a second. So this is an area where it pops up, it pulls back. It does have resistance at 1150, right? It hits resistance, it drops down, and it gets right through it. MACD in favor of the trade, positive. Volume profile, light volume selling. Did it consolidate for too long? Not really. So this to me checks out as being worth a stab at 1150. We get the move up to 1150, up to 1250. There we get a little bit of a rejection, a little dramatic, right? We get that pop up to 1271 and then that flush. Now we had a little one right here. This one was bigger, all right? So this one right here, this is just a typical rejection. You get the move higher, pull back, the pop, and then sellers come in and push it back down, okay? So then as we come into the day, what ends up happening is this tries to push higher, and then this candle right underneath 12, it looks like it's going to break 12. 12 sort of resistance right here. And let's actually, let's switch to the 10-second chart. We'll switch to the 10-second chart just so we can get really zoomed in on this. What you're going to see is that this was consolidating right underneath 12, and then it flushes. And when it drops, you just get such a nasty rejection. There's really no hope for recovery. That's what's so frustrating about it. It's just instantaneously you're deep in the red. Okay, so it was right here. So see this? So here we squeeze up, we pull back just for a moment, $12, right? $12 resistance, and then flush all the way down. And this actually went all the way from 12 down to 1040, and it halted down. It opened lower. So that was a really dramatic rejection. You just don't like to see that. It's not pretty. So this was VSTE yesterday, pretty dramatic rejection back there. We also had CXAI yesterday. This one put in some pretty dramatic rejections, and I saw traders getting frustrated with this one as well. So CXAI traded over 100 million shares of volume. It was incredibly thickly traded, crowded even, and look at these rejections. So they started fairly early with this one right here, right underneath $5. So it comes up to 5 and then flushes all the way down to 4. All right, red flag. It comes back up again, flushes again. So now you've got 1, 2 big rejections. It does end up grinding higher, but it's really hard to trust. The volume is lighter as it moves higher because people don't trust it. It comes back up, it gets over 550, it gets up to 6, and then look at this rejection right here. And look at the volume. Nearly 2 million shares of volume in this candle. So it goes up to 650, up to 660, and then dumps right back down. Again, what's the position of the MACD on this trade? Position of the MACD, negative, right? Volume, well, at this point, this already has established history of rejections. Right here, this rejection, MACD is negative. Now, on this one, well, I guess the MACD is actually still negative. It's starting to curl back up, but it is still negative. If you just did one thing, and it was to say, I'm not going to trade to the long side when the MACD is negative, it would prevent you from getting in and getting caught in a lot of these false breakouts. It would stop you from buying some dips off of VWAP, some of these deep flushes. It would stop you from that. But I would say when it comes to breakout trading, you should be very cautious trading breakouts when the MACD is against the trade. Buying dips when the MACD is against the trade, if you're buying like a big flush, well, you're already getting in on a low, so you're probably going to be a little bit better off with that. But buying dips when the MACD is against the trade, you're going to get yourself in trouble. So we saw it on these two yesterday, VSTE and CXAI. And these are just, three of the most recent examples. I have a section in my class specifically on bull traps because it's something that we see again and again and again. And this is not new. This isn't like something that, we never used to see this and now we're seeing it. This is a chart from 2018. It's the same pattern, high volume rejection. This chart is from 2017. This one's not quite as dramatic, but a little rejection there. This is one from 2017, right? So, these are the same, just those rejection candles, and they become predictable once you train your eye. Once you train your eye to recognize these, they become more predictable. I'll show you a couple others here. I've got a folder of screenshots that I've saved. This was a higher volume rejection right here. This one, this one is a little bit less concerning. When you have the proper pullback and it squeezes up, you could still make money on this. You could take profit and you could get out when it comes back to break even. So that one's not as concerning. The ones that really get me is when you have that kind of move, that pop up and then that flush all the way back down. Those are frustrating. And I get it. It's easy to get caught in these kind of whips if you're not really on your guard. So again, there's no doubt the MACD was against this trade. The price is basically going sideways. So it starts to break out of consolidation and then it flushes. To help you kind of better understand the dynamics of what's happening in these moments, when you've got a stock, and it doesn't have to be a stock, it could be futures, it could be a commodity, it could be a Forex pair, but when you have this period of going sideways, you have this period of sideways consolidation here. If it's been going sideways long enough, what often happens is as you keep getting pressure against this breakout price, eventually you're going to get a squeeze through that level. And if you have a really strong catalyst, it can break and it can keep going higher. However, what's more common is after this long period, this first attempt, this first pop, you're going to have people who have been holding for a while who are going to sell and take profit. So you have sort of a couple things that happen at the same time. First, you have people who have been short who are like, oh, I better cover. So they buy, and essentially what comes through the market are a ton of buy orders. When all these buy orders come in at once, the high frequency trading algorithms and the market makers, they actually pull back their orders. So all of a sudden, if they were selling at 705, if they were on the offer at 705 and 725 and 750, they just pull their orders right straight away. They take them off the market. So all of a sudden, all those orders are gone, and now the only orders are left are, let's just say, a few orders at 730, 740, 760, 770, and boom, you get that big squeeze up. Now, as soon as some orders start going through to sell, now you get orders, well, this should be at the top. Now you get orders that are going through to sell, because some people are like, well, I just locked up a nice profit. Boom, a big chunk of sell orders go through. And now the market maker does the same thing. All of their sell orders go back at 750, 725, but their buy orders are gone Because when people are selling, they have to be on the bid to buy shares. So they take away their buy orders, and now those sellers are sweeping the order book all the way down. And that's why we call it both an algo spike and an algo flush. And this is exasperated by high frequency trading algorithms. High frequency trading algorithms provide a lot of liquidity during periods of sideways consolidation. But as soon as the markets start to break out of sideways consolidation, those market makers pull their orders off the book. So they pull their orders off the book to the long side when the stock is popping up. Those orders that are on the offer, they're gone. And so you can get that rapid spike. And that's why if you've ever seen a stock with breaking news, like right at 8 a.m. or 8:30 or 9, that goes in a matter of minutes, and VSTE was actually a good example of this yesterday. VSTE went from about $4 a share, $4 a share, all the way up to $12 a share. And it happened almost instantaneously. So the way that happens is all of a sudden, a bunch of buy orders go through. Now, the reason those buy orders went through was because the company posted news. So there are some traders who have programmed trading bots, essentially, to execute buy orders as soon as they see certain news headlines. So these buy orders start going through, and what the market sees is all of a sudden on the order book, there's just a ton of green orders going through. Green orders, green orders, green orders. So the level 2, right? So you've got the level 2 with the bid and the offer, and the bid and the offer are constantly moving, right? The orders are constantly moving. And market makers on both the bid and the offer. They sit on both sides. They buy and they sell, they buy and they sell. And their goal is to buy and sell the same number of shares each day and to profit from the spread that's in between. So when you have a 5-cent spread, if they sell, well, let's just say they only did 10,000 shares, they'd make $500, right? If they do 100,000 shares, they'd make 5,000. If they do 1 million shares, they'd make $50,000, right? Just across the spread, across the spread, across the spread, all day long. So they want to buy and sell basically equal amounts. They don't want to be too heavy. So if all of a sudden a stock starts spiking up, they have to pull their sell order. They can't sell an infinite number of shares as something is spiking up, because then they would effectively be short the stock. That's not going to work, and that would mismanage their risk. So as soon as that volatility peaks and starts to come in, they're pulling their orders off the book. Now, that actually increases volatility because without their orders on the book, there's not liquidity. And now you see these stocks that will jump from 4 to 5 to 7 to 8 to 10 to 12. We saw one a couple weeks ago that went from about $5 to $25 a share. And that happened in part because market makers are just taking their orders off the book. But then when the sell orders come in, all of a sudden it gets up high and someone executes a sell order for 20,000 shares, another 20, another 20, another 20, another 20. Now the exact opposite happens. Their orders, they're not on the bid either. And so all of a sudden you get this really dramatic move where you get this quick squeeze up and then you can get a quick reversal. Now, if the catalyst is strong at the beginning of the move, then it's not going to drop too much because more buyers are going to come in to buy the next leg up. But when you have something that's been in a longer period of consolidation, the MACD is against the trade, the volume profile is poor, it's got a history of false breakouts, then there's a high likelihood that there's an insider dumping shares. There's an insider who's happy to sell, the stock's up 100%, and they're pressing the sell button. And they may even be doing essentially marketable orders. They're in at such a low price that they don't care the difference between 7 and 650. They're just going to sell 100,000 shares, 200,000 shares. Now, sometimes what will end up happening is later in the day or a couple days later, we'll find out that the company actually did a direct offering. They sold 1 million shares onto the open market to raise money, right? That happens sometimes. So we don't always know where the selling is coming from, but what we can identify is that there's more selling. It doesn't usually happen immediately. It's not usually like, now, well, I'll say every now and then something will pop up and like within a minute, you'll see an order for 50,000 or 100,000 shares. And whenever I see that, I'm like, somebody was ready. Someone was ready to sell, and I'm not going to trade this anymore because now it's going to have a ton of false breakouts. Obviously, someone is unloading, but that's not as common. What's more common is that you get a nice, clean sort of first leg up. You may even get a nice pullback, as we did today on VVPR on the 1 minute, a nice 1 minute pullback and a move higher. And sometimes, on a really strong stock, if there isn't an insider who's dumping shares at a, kind of high rate, you could get a move where this goes, pull back at 450, goes up to 7, pulls back at 750, goes up to 8 to 10 to 12. And it just continues higher. And when it does that, I'm going to keep trading it. The MACD is going to stay open. It's going to be the first leg of the move. And yes, you're going to have little pullbacks here, but we're going to be super strong. This is literally the micro pullback strategy. So again, you could download the PDF. It's pinned at the top of the comments. It's in the description. The way this works is as soon as the stock has news, the market will start reacting. If the news is valid, if it's like a substantial type of news headline. So once the market starts reacting, then the stock is going to hit my scanner. When it's on my scanner, then I pull it up and I do my due diligence. So what am I doing? Number one, I'm checking the price of the stock. I'm looking at the float, which is the number of shares available to trade. I'm looking at the percentage gain, how much it's up right now so far in the day. I'm looking at the relative volume, RV, today versus what's normal. And then, of course, number 5, I'm checking to see what the news catalyst actually is. Then I'm pulling up the daily chart. I'm looking at the chart. I'm asking myself, is there any nearby resistance? Where's the 200 moving average? Are there any gaps or windows? And if all of that checks out, I'll also ask myself, is this a recent IPO? Is it a recent reverse split? Does it have something in the daily chart that gives it a little bit more, punch? And if it does, then I'm looking to buy that first pullback. So I'm going to be watching the chart. I'm going to see the stock is squeezing up just like this. And then we get that momentary kind of pause. Sometimes it's just one candle like that, and then boom, it continues. Now, this could be happening on a 10-second chart. It can happen so fast. But in this period right now, the MACD is, of course, it's always open. The MACD is open. Generally, the volume profile is going to be positive, but naturally, if we had low volume green candles and then this, candle was high volume red, that would, of course, not be a positive volume profile, and I wouldn't take the trade. So I encourage you to download the Micro Pullback Strategy PDF so you can get a better sense of how I'm trading these on the front side of the move. And again, if I make enough money on the front side of the move, then I don't overstay my welcome, right? Why mess around with it once the MACD crossovers, once we have that crossover, once we start to get a choppier volume profile with higher volume red candles. Those are the times where we're going to be more susceptible to seeing the false breakout and that big jackknife move that has the ability potentially to, you can have a trade where you give back everything you've made on the morning, because those jackknife rejection candles, they can be so big. You could lose $1 a share in an instant. It can happen so fast. And that's what I saw traders complaining of today, but this is just the latest example because we've seen this forever. So it's the traders who learn to recognize those subtle hints that this stock might be one of the ones that's going to give you a false breakout. Those will be the traders that find long-term success. So, you'll get that feeling when you see that long period of consolidation. You keep seeing those topping tails, like it's just hitting its head. It can't do it. The MACD is crossed over. The volume profile showing higher volume on the red candles. It takes a lot to be able to sort of register all of that in real time and then to make the decision that I'm not going to take this trade, which is obviously the benefit of trading in a community with other traders who you can sort of piggyback off their cumulative experience. Because I saw people today in the room, I saw a couple of people who were like, I think this is going to do a false breakout. And I was like, I'm so happy that you said that because you're learning to read this chart the right way. Where was I? Okay, back to the chart. So by the time we finally are forming a 5-minute pullback, if it's gone parabolic, it may be too extended. It may need to pull all the way back down to the 9 moving average. And if it does, and it does rally back up, I usually don't find myself doing as well on that second kind of leg of the move, because usually by that point, the stock starts to get too crowded. It's just too thickly traded. You've got these big orders going through, people dumping shares. It's just not as clean anymore. So I think if you, again, follow these 5 tips, these will help you avoid getting caught in false breakouts. One of the things I did starting in the bear market of 2022 was I just kept the MACD on my 1-minute chart at all times. And I just said, you know what? I'm just going to leave it on my chart and just keep it as a reminder to check this as a cross-reference. And if the 1 minute is against the MACD is against the trade on the 1 minute, I don't want to trade it. Now, look, occasionally I will take a trade anyways, and it's a higher risk trade. I acknowledge that, and I trade it with smaller size. But as a beginner, if you're trying to build a track record of consistency, you've got to stay focused. You can't afford to make mistakes. And so you've got to really follow, I would say, as much guidance as you can to avoid getting caught in these kind of bull traps. Because this type of setup, it's a nice setup, but then if you end up losing $1 a share, it ruins your profit loss ratio. It's totally not worth it. So I hope this episode's been helpful. This is something that I know a lot of you guys have been asking about, and we've seen some false breakouts. So if it was helpful, I hope you hit that thumbs up. I hope you subscribe to the channel, and make sure you stay tuned for the next episode, which will be coming soon.